Hello there, I hope that you're doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on higher time frame institutional order flow. Before we dive into the lecture, I first want to share the following quote with you. If you cannot anticipate the move taking place based upon the higher time frame charts, you have no purpose dropping into lower time frame charts. Meaning, if you cannot see the move taking place, which you anticipate based upon the higher time frame chart, you have absolutely no purpose going into the lower time frame chart. The reason why is because if you zoom into the lower time frame charts too quickly, you are likely going to get lost in the price action. Therefore, it's crucial that you learn to establish a higher time frame narrative first of all, and that's what we will discuss during this lecture. Defining institutional order flow. Bullish institutional order flow is present when price is expanding higher, retracing lower, and expanding higher. Premium rates will get violated and discounted rates will get created, which will function as support on price. Bearish institutional order flow is present when price is expanding lower, retracing higher, and expanding lower. Discounted rates will get violated and premium rates will get created, which will function as resistance on price. These are the two definitions of both bullish as bearish institutional order flow. We also have neutral institutional order flow, but that is basically when there's no one-side order flow present, and that is when you anticipate the consolidations taking place. Throughout this lecture, however, we are going to focus purely on bullish and bearish institutional order flow. Let us first take a look at bullish institutional order flow. Bullish institutional order flow is present when the market moves from point A, which is on the bottom left right here, to point B, which is on the top right. This is the schematic which I introduced to you throughout the price cycles lecture of this model series. This is the schematic which we're going to work with moving forward. Keep this schematic in mind. What we can see right here is that I've created price action and I've annotated two lines. I've annotated a red line on the lower end, which represents a point of interest, and I annotated a green line on the top right here, which represents a draw liquidity. Right in front of you, you can see a visual representation of the market maker buy model. The market maker buy model takes place in markets which are trending higher, which are being repriced towards the upside, meaning there's bullish institutional order flow which is present. What you will see in bullish markets is the following. What you will see is that the market will begin to consolidate, and this consolidation right here has one function. That function is to engineer buy-side liquidity above these relatively equal highs. Retail-minded traders will look at these highs as a strong resistance area having been reached. When the market then expands towards the downside, it confirms their existing idea of a strong resistance area being met. They see the market expand towards the downside and we see it retrace higher to continue expanding lower. This continues until we reach the point of interest right here. Meaning, you can see that we were in a sell program from this area all the way to the point of interest. Meaning, the price swing which was taking place was A to B. Eventually, the point of interest gets met, and what we can see is that point B turns into our new point A, and the next price swing which will occur is from point A right here to point B. If you do not understand what I mean by the use of the language of point A and point B, I highly suggest you to go back to the price cycles lecture. What you can see is that the market repriced lower into the point of interest, and we see the market begin to show the signs of forming a reversal in this area. Now, what I will outline to you throughout this lecture is specifically how you can recognize that order flow is changing from bearish to bullish. When we pay attention to the following schematic then, what you can see is that I've outlined two blue shaded areas right here. What these blue shaded areas represent are imbalances which formed throughout this repricing towards the downside. Now, what I want you to pay attention to is first of all the following imbalance right here. This imbalance in particular is very important to monitor because this imbalance formed throughout the final price swing which reached our point of interest. Meaning it reached the area where we anticipate a buy program to unfold off. Therefore, what we will be monitoring is the following. What we will be monitoring is the reaction to this imbalance. If we would begin to see the market displace above this imbalance, utilize that support on price, from that moment in time, we can confidently say that order flow has changed from bearish to bullish. pay attention to the word use of the imbalance which formed throughout this final leg towards the downside. That's a key insight which I want you to write down. Now, what you can see then is that the market reprices into the next imbalance which formed right here. Notice that we initially reject this imbalance and we retrace. This right here is very important to note, and the reason why is because of the fact that the market is retracing into this old high right here. What I want you to understand is that the fact that this premium ray in the form of a CB failed to function as resistance on price is the first sign to you that order flow is changing from bearish to bullish. Next to that, what you're seeing is that the market is trading above an upclose candle, which will have formed throughout this swing high formation in this area. The fact that this upclose candle did not function as resistance on price shows to you that the underlying order flow is changing from bearish to bullish. Because what you can see right here is that inside of this high formation, you will see a bullish breaker form. Why is this a bullish breaker? Well, what you can see is that the market expanded lower and we formed this low right in advance of the point of interest. Notice that a retracement higher took place and the market then expanded towards the downside once more, taking out the sell-side liquidity engineered below this low. Notice that this high also set up the final run into our point of interest. The moment that the market displaces above this high, we anticipate that the final upclose candle which will have formed in this area will function as support on price, because this upclose candle is your bullish breaker. When we pay attention to the delivery in this area then, what you can see is that I've also outlined that the imbalance will form the moment that we reprice through this high. Notice that the imbalance doesn't necessarily have to form exactly at this high. It can also form just a bit below it or a bit above it. What matters is that inside of this impulse leg higher, there will be one or multiple imbalances. What these imbalances suggest to you is that the order flow is changing from bearish to bullish. Why? Because a premium ray is being violated right here and a discount array is being created. Next to that, you can see that I've annotated this light bulb emoji. The reason why I've annotated this light bulb emoji is because what you can see is that this high right here formed inside of a CB on the left side of the curve, a bearish fair value gap. Notice that the market retraced into that and then expanded lower. We then saw the market displace above this high with an imbalance. This right here is what I refer to as the juicy market structure shift pattern. This market structure shift pattern is present within a lot of the market reversals which you will see. If it's not present on the time frame through which you are looking at the markets, I highly suggest you to drop into the lower time frames and investigate whether or not it's there. What we can see is that the market retraces into that bullish breaker, that red shaded box. It retraces into this bullish fair value gap and notice that the market finds supports there before expanding higher. Isn't that interesting to think about? How did I define bullish institutional order flow to you? I outlined to you that when the market expands towards the upside, retraces lower, and then continues its expansion higher, that right there is bullish institutional order flow. On the lower time frames, what you will see is the following delivery taking place. So meaning inside of this retracement lower, followed by this expansion higher, you will see this schematic right here on the lower time frames. Meaning you will see a lower time frame market maker buy model. The same applies to the next expansion leg, followed by a retracement, followed by another expansion. And the next. And the next. Guys, I want you to put this in your mind and I want you to investigate this. Because I'm telling you right now during this lecture, this has been hidden underneath your nose all this time. Because the point of interest right here, which I've showcased by this red line, could be, for example, this bullish breaker, its range. Yep. What could the draw on liquidity be? The draw on liquidity could be this high or a level above. Are you beginning to see how everything is fractal? Simply by me explaining these schematics to you. Now what you can see is that the market eventually expands higher as outlined, and throughout these expansion legs, what you will see is that new imbalances will get created. These imbalances will function as points of interest down the line. When we pay attention to a chart example then, what you can see is that the market expanded towards the upside, and throughout this expansion leg, what you saw was that this imbalance got created. Notice that the market retraced into that imbalance multiple times before eventually expanding away from it. Notice that a new imbalance got created. We see the market expand higher, retrace, and then expand higher once more. What is present right here in this area on the lower time frames? On the lower time frames, you are going to see the signs be present of a market maker buy model, of lower time frame bullish institutional order flow. Why? Because on this chart, you can already see that the market is expanding higher and discount arrays are being created. These discount arrays are functioning as support on price. So that means that on the lower time frames, you are going to find buying opportunities. When we pay attention to a chart example then, which is taking place on the lower time frames, what I want to see is that the market was repriced towards the downside, and notice how it was going back and forth throughout this repricing lower. Notice how it wasn't really quick. We see the market reprice towards the downside, and we see it take out the previous day low, which was right here. We see the market trade deeper into the price range of that imbalance, which I had outlined. We then see the market eventually show the signs of forming a swing low. How do we see these signs? Well, what you can see is that we dropped towards the downside, formed this low, retraced, and then we saw the market expand lower one more time. Notice that we quickly take out sell-side liquidity engineered below this low, and we then see the market displace towards the upside with this very large green candle right here. This green candle right here shows to you urgency, it shows to you speed. We see an imbalance getting created, and the market retraces into that imbalance. Notice that that imbalance functions as support on price, and we see the market begin to expand towards the upside. Notice that by this time, we have already traded above the high, which set up the final run towards the downside. And therefore, you can confidently say now, alright, we have likely formed the smart money reversal within a new buy program, within the new buy side of the curve, within a market maker buy model. Sell side of the curve, the market is being drawn towards sell side liquidity, it's being repriced lower, eventually we form the smart money reversal, and the market is reversing and drawing towards buy side liquidity. This is the buy side of the curve. We see the market eventually expand higher, and a sequence of two imbalances gets created. Notice that I've annotated the highest imbalance right here. Why do I have specifically this imbalance annotated? In order to understand why I'm specifically monitoring the reaction to this imbalance, we need to take a look on the left side of the curve, meaning we need to pay attention to the left. I would like you to pause the lecture for a moment, and I would like you to try and think about what you could see right in front of you right here. Think back to what I just outlined within the market maker models. Some of you don't like to pause these lectures, you just like to watch them, maybe even at twice the speed because you want to get done with it right, and then you think that that is going to provide you with all the knowledge which you need. Nope, just watching these lectures is not enough, and if you don't pay attention to detail, you're not going to gain the benefit that someone who doesn't rush through them actually gets. What I want you to see is that when we pay attention to the left right here, what you can see is that we formed this high. We saw the market initially expand lower, retrace higher, and then that high was formed. Notice in what that high formed. That high formed inside of this CB on the left side of the curve. Therefore, the moment that we displace through this high with an imbalance, we anticipate that that imbalance is likely going to function as support on price because we displaced through this high. This is a variation of the market structure shift pattern, which I had outlined to you throughout the schematic, but now at a later stage within the market maker buy model. Meaning initially I showed it to you within the low risk buy, but that market structure shift pattern, guys, takes place all throughout the market maker models. And therefore you can see it function as support right here. Consolidation takes place inside the price range of that BC, and eventually the market expands higher one more time. Notice that the new imbalance forms right here, and we see the market retrace into that imbalance before expanding higher, drawing towards buy side liquidity, resting above the previous day high. Now, when we're paying attention to this chart, main takeaways is how we recognize the bullish institutional order flow on a higher time frame chart and then dropped into a lower time frame chart to confirm the bullish institutional order flow by paying attention to how the market is reacting to new discount arrays which are being created inside of a large imbalance. When we pay attention to another chart example then, what you can see is that I've dropped straight into the 1 minute chart on the lower time frame chart. The reason why is because this is actually part of a trade breakdown lecture which I released during the time of releasing this model series episode as well. The trades breakdown lecture is called Trading, Consolidating Markets, and basically buying and selling in the range. Meaning, what you can see is that I bought inside of this range and eventually I also sold right here on the right. You can go to the trade breakdowns and find this lecture. Now, the reason why I wanted to put this schematic in is due to the following. What I want you to see when it comes to this chart example is the fact that we saw the market reprice towards the downside right here. We saw it create a CB throughout this repricing lower, throughout this quick repricing lower, and we saw the market retrace into that CB. Notice that we formed this high, and we see the market displace through that high with an imbalance. Notice that at this moment in time, the market is also repricing above this CB right here. Therefore, what we're monitoring is whether or not that newly created imbalance is going to function as support on price. If it will, we can anticipate that we're likely seeing order flow changing from bearish to bullish. Guys, recognizing changes in the state of delivery where order flow is changing from sell program to buy program is crucial. But please keep in mind that there's more that is required in order to confirm that order flow is in fact changing. And that is one of the most important things which I can share with you, is that don't get lost in the lower time frames like I mentioned prior. Focus on recognizing the higher time frame narrative. Do you see how I just outlined to you based on a 1 minute chart, the lower time frame buy program which you're seeing unfold right here? But without a proper understanding of the higher time frames, you would still probably get lost inside of this delivery. Therefore, it's crucial that whenever you break down your trade, or you break down your backtesting log, or you break down my trade, it's crucial that you first always log a higher time frame to try and get a feeling for what the higher time frame narrative is, so that you can then go into the lower time frames and look to confirm that higher time frame narrative. Let's now take a look at the bearish side of things. Let us take a look at bearish institutional order flow. For bearish institutional order flow, what you can see is that the schematic of A to B is of course inversed, where you can see A on the top left and B on the bottom right. When we pay attention to the schematic, what you can see is that's basically the buy program inversed, meaning what you can see is that we see a market make a sell model schematic, where there are two lines. First of all, this line on the downside represents your draw liquidity, and the line on the upside, the green line, represents your point of interest. What I want you to see is that the market was consolidating down here. The function of this consolidation is to engineer sell-side liquidity. Sell-side liquidity is being engineered below these relatively equal lows, because a lot of retail mind traders will be looking at those lows and will be thinking to themselves, hey, we reached a strong support zone, that's why the market is failing to reprice through this level. We, however, know that this is not the case, and we know that this is the engineering of liquidity which is taking place. The market begins to expand towards the upside, and we see it retrace lower. Eventually, it continues its expansion higher, and we see the market begin to draw towards the point of interest. The moment that the point of interest gets met, we can be monitoring whether or not the signs become present of a reversal taking place. We see the market eventually form this swing high and begins to displace towards the downside. Notice that we displace below this low, which set up that final run higher. We'll get to that in a bit. What I want you to understand is that we change from buy program to sell program. And therefore, what you can anticipate is that every single retracement higher is likely going to be manipulation to distribute lower. And that is a key insight which I want you to take away from this lecture already. And that is that when you have a draw liquidity established, you're actually looking for price runs against that draw liquidity for a while. The reason why is because those price swings are more confirmation of your existing draw liquidity to be the right draw liquidity. Why? Because liquidity will seek to be engineered around your draw liquidity. And that's something which you need to keep in mind. Understand as well that we saw the market move from point A to point B, and now point B turns into point A to draw towards point B. When we pay attention to the imbalances then which get created on the left side of the curve, throughout this buy side of the curve, what you can see is that I have annotated two imbalances. One right here and one inside this final expansion leg higher. Now what I want you to keep in mind is that throughout this final run higher, what has taken place is that a lot of buy side is being taken out. And at the same time, what's taking place is that traders are being trapped into believing the markets are just going to continue running forever. Therefore, what you see is that there's speed and velocity which is taking place. Big upgo candles will step in. It's in those big upgo candles and an integration of the price pattern of an imbalance that you must be wary. And the reason why is due to the fact that you understand that the point of interest has been met, also during a time of interest, which we'll discuss later throughout this model series, and therefore you can anticipate a smart money reversal taking place. The moment that the market displaces below that imbalance and we begin to see this discount race fail to function as support on price, we can anticipate that it's likely going to function as resistance on price moving forward, and that the order flow changes from bullish to bearish, especially considering the fact that your draw liquidity is down here. When we pay attention to this low right here, what you can see is that I've plotted a red box. This red box represents a bearish breaker, where you saw the market expand higher, create this high, retrace lower, then we finally saw the expansion taking place higher into our point of interest. Now what's a crucial insight here is that buy-side liquidity was engineered in advance of the point of interest. We see the market form a higher high, and we then see it displace below the last down close candle which set up that run higher. Therefore, from this moment in time, we can anticipate that this down close candle is likely going to function as resistance on price. Why? Because the order flow changed from bullish to bearish. Now, please keep in mind that I'm not teaching to you price patterns for the sake of price patterns. I'm explaining to you a certain logic which is based around understanding time-based delivery profiles. How price should deliver between fixed windows of time that do not change. Meaning, these time windows which I'm going to teach you more in depth throughout this model series are the same always, and they will never be adjusted. And the reason why is because in order for you to objectify your analysis on the markets, you must subscribe to objective theories, and objective theories are always based upon time and price. Price you have been introduced to throughout the first real lecture of this 2025 model series, and time you have been introduced to in depth throughout the second real lecture of this 2025 model series. More on those topics will get shared in due time, but I must make sure that you have a good foundation before we dive into all of that good stuff. This down close candle is your bearish breaker, and we anticipate that it's likely going to function as resistance on price. It has to in order for the order flow to remain bearish. When we pay attention to that down close candle, what you're likely going to see is that down close candle being displaced through by an imbalance, specifically a bearish survival gap, a CB. Meaning throughout this expansion leg lower, you are going to see an imbalance being created right here. What you will notice as well is that I've annotated the light bulb again. This light bulb is important because it shows to you that this low formed inside of an imbalance on the left side of the curve. Therefore, the moment that we see price displaced through that low with another imbalance, we can anticipate that we're likely going to see the market find strong resistance inside this red shaded box. And I do not really like to use the word resistance or even support in general, but it's a very easy way of describing the market rejecting this range to go lower. Now, what's important to note is that when you do not see this price pattern on the current time frame that you're looking at, you can zoom into the lower time frames and try and see whether or not it's there. Next, that you can see that multiple imbalances will get created, and we see the market retrace into those imbalances, for example, here. What you must understand is that the creation of these imbalances, followed by the retracements into them, provide even more lower time frame trading opportunities, because it's inside of those retracements legs higher, whilst the higher time frame institutional order flow is bearish, that we can anticipate that we're going to form a nice swing high before continuing to expand towards the downside. This is what I mean when I outline to you, I'm interested in trading the low resistance security run. In order to define what the low resistance security run is likely going to be, I pay attention to the higher time frames only, and based upon those higher time frames, I try to determine what's likely going to be a low resistance security run and what not. When we pay attention to a chart example then, what you can see is that we saw the market initially expand towards the upside, but notice how slow it was. Notice how it was just going back and forth, back and forth, back and forth. There weren't any real pretty arrays which got created. Eventually, we saw the market take out the buy side liquidity engineered above this high, and we then saw it begin to roll over. Notice that when the market began to roll over, we saw it create multiple imbalances right here. Notice, however, that both these imbalances were allowed to be left intact, meaning we didn't see the market retrace into them. These open imbalances are now called breakaway gaps. These breakaway gaps are suggesting to us that we're likely going to see speed and velocity towards the downside even more soon. We see the market eventually reprice towards the downside, taking out sell side liquidity engineered below these relative weak lows right here. We then see the market retrace, and a daily imbalance gets created, a daily CB. This means that moving forward, as long as this CB does not get displaced above, I'm expecting lower prices. And that's my thought process for the lower time frames as well. So that means I'm going to be looking for signs being present of market maker sell models. Notice that we see the market retrace into that ACB. New day opens up, we open high, and the market then begins to expand towards the downside, taking out sell side liquidity engineered below this low. When we pay attention to the lower time frame then, what you can see is that we saw the market consolidate right here, and we then saw it begin to run towards the upside. Notice that this rather large imbalance gets created. We see the market consolidate after having traded into it. Market is just going back and forth, back and forth, back and forth. Eventually, we see the market reprice towards the upside quickly. We see a takeout buy side liquidity resting above this high. We see the market form a swing high and begins to displace lower. Notice that the market is being repriced into the price range of this BC right here. We see the market find support inside of that initially, and a retracement higher takes place. Now, what's the function of this retracement higher? The function of this retracement higher is to make sure that new liquidity gets engineered. New liquidity will get engineered below this low. So when we see the market retrace higher like this, you must understand that this is manipulation which is taking place, and after that you can anticipate distribution to follow. Eventually, we see the market expand towards the downside. And how do we confirm that the bearish institutional order flow is going to last? How do we know that we were right about point A being up here and point B being down here? This being a crucial sell side liquidity pool. When you pay attention to the delivery which took place relative to this blue shaded box, what you can see is that the market initially found support inside of that. Notice, however, that this imbalance did not set up a new run towards the buy side liquidity pool resting above this high. Instead, we saw the market eventually begin to roll over and begin to displace through it. Notice that we saw the market reprice below the imbalance right here. Next candle opens high, and we see the market continue its expansion lower, drawing towards sell side liquidity engineered below this low. When we pay attention to another chart example then, what you can see is that we saw the market expand towards the upside right here, and eventually we saw the market take out buy side liquidity engineered above these highs, which repriced towards the downside. Notice that we saw the market form a new swing high, and we saw the market eventually begin to run towards the downside. Notice that we saw this imbalance, this bearish value gap get created the moment that we displaced through this low. Why is this low in particular important? Because we saw the signs of a high formation, low, lower high. So this tells you that this down close candle right here is your bearish mitigation block, and therefore this must function as resistance price. If we are in fact going to see a very bearish delivery profile taking place, we are likely going to see the market retrace into that imbalance and immediately begin to expand away from it. Notice that we see the market tap into the imbalance, taking out this candle's high and immediately running towards the downside. This is what we refer to as institutional order flow entry drill. And this right here shows to you that there's an urgency for the market to reprice lower. Now, what you can see is that I did not annotate the green and red line within this example. The reason why is because I want you to begin to be able to determine where point A is and point B is. So I would like you to pause this lecture for a moment. I would like you to think about the following chart image. I would like you to try and basically write down for yourself or visualize for yourself where you would put point A and where you would put point B. I know that for the majority of you, it's too hard to right now even envision where that would be the case. But trust me, in due time, with more practice, this will all make sense. And once you're able to basically say what I'm about to say before I mention it, that's when you know that you're on the right path. What I want you to see is that I mentioned to you that we saw the market run up higher quickly, taking out buy side liquidity engineered above these highs right here. When I see these highs on the left, I see engineered trendline liquidity. And the reason why is because you can see that the market is very nicely making lower highs all the time right here. So retail-minded traders are looking at that as a sense of weakness. They are looking at that as, oh, the market is very bearish, we can place our stop above the trend line, boom, that's the job done. We see the market, however, begin to consolidate in this area. Eventually, this consolidation leads to an expansion leg higher. Notice, however, how these relative weak lows were left intact. We see the market run higher, and notice that we see this imbalance getting created. This imbalance by itself is already a potential objective on the downside if the market begins to change from buy program to sell program. Notice that we see the market eventually form this swing high above key buy-side liquidity pools. What buy-side liquidity pools I'm referring to? I'm referring to the highs which formed and set up this trend line right here. And therefore, the moment that we take out those highs, this becomes my point A. What becomes my point B? Well, I have 2 points B, so I have 2 potential targets. First of all, this imbalance right here. But secondly, also the sell-side liquidity engineered below these relative weak lows. And next to that, we could even go as far, and this is looking at it from a micro scale, we could be looking at this delivery right here, and we could argue, okay, well, the CB right here, so the low of that CB is point A, and point B is the previous day low, this sell-side liquidity pool right here. That would also be valid. All that matters is that you're able to recognize when the order flow is changing, because once you're able to recognize that the order flow is changing, you can anticipate what the next delivery profile is likely going to be. When we zoom into this delivery then, and we pay attention to specifically an hourly chart, what you can see is that the market opened up for Friday, and we see it run higher. The market trades into that imbalance, that blue shaded box, and just taps it. We just take out the previous day high, and the market begins to roll over eventually. We see the market begin to displace towards the downside, and we see multiple imbalances getting created. Notice, however, that we see these imbalances getting created throughout a price swing which already takes out the previous day low, which was right here. Therefore, what do you know in order for the underlying order flow to remain bearish? What we must see is that the imbalance or sequence of imbalances in this case that set up the repricing into that objective of the previous day low, they must function as resistance price. So we see the market retrace higher, trading back into the price range of that CB right here, that bearish value gap, and eventually we see the market continue its expansion lower. That tells you for the next week that you can also anticipate further continuation lower, as long as we do not see the market displace back above this CB. Why oh why do I choose the imbalance which I choose? I just outlined throughout this lecture a crucial element when it comes to selecting the key ranges to monitor. I want to give you a homework assignment to end this lecture. I would like you to find 15 examples of a trending market in which you see one-sided order flow taking place. I want you to zoom into the lower time frames and find the market maker models present, whether it be market maker buy models or market maker sell models. I want you to annotate everything as detailed as possible. Meaning, I would like you to try and annotate everything which you see when it comes to the PD rates which you see, when it comes to recognizing A to B or the multiple A to Bs, recognizing the use of time cycles, recognizing maybe even intermarket relationship if you're already investigating that. Annotate literally everything. And the reason why is because it's inside of this assignment where you focus on spotting trending markets and looking at the lower time frame opportunities that you will be able to see that there are countless opportunities each period. I hope that you enjoyed this lecture. I want to thank you for watching it all the way to the end. I look forward to speaking to you in the next one. Good luck with the assignment, and I look forward to seeing the charts coming in on the mentorship form, because that is where I suggest you to post them if you want to receive my feedback. You can just tag me in the questions channel and I will do my best to get back to you as soon as possible. Good luck with your studies, and we'll speak soon again, Lord willing. Be safe.